Okay, hello to everyone. This is Dan I with our third quarter update. A lot going on in markets, so we're excited to give everyone an update on new developments, some thoughts, and a bit of an overview of how we're positioned in portfolios. As always, I'll run through the disclaimer information quickly, and then we can get started. So this webcast is for informational purposes only and does not constitute a complete representation of Roof Advisory Group services. The information presented on this webcast should not be considered personal financial advice. Any use of information from this webcast for personal use is at your own risk. Information throughout this presentation is gathered from sources Roof Advisory Group believes to be reliable, but we do not warrant or guarantee the timeliness or accuracy of this information. Our discussion today will consist of forward-looking statements. Actual results or trends could differ materially from our outlook. Roof Advisory Group assumes no obligation to update any forward-looking statements or information which speaks as of their respective dates. Roof Advisory Group is a division of Fort Pitt Capital Group. Information for any index or ETF provided is meant to reflect the performance of certain segments of the market. It does not represent the performance of any roof strategy or client. Visit www.roofadvisory.com. Okay, with that said, here's a look at today's agenda. As always, we'll go ahead and start with a review of the third quarter results for some of the major equity and fixed income indices. And as you can see here in our chart, we experienced some weakness in equity markets in early to mid-August as China trade tension ratcheted up again, and with the news of additional tariff increases. But consistent with the recent trend, the flare-up didn't last very long, and we closed the quarter with positive performance results for bonds and U.S. stocks. And foreign and global stock indices registered declines in the third quarter, and we've seen pretty steady and consistent outperformance from domestic stocks this year. So we're feeling pretty good about our decision and our moves in 2018 to eliminate dedicated foreign stock exposure from portfolios. And just as kind of a sidebar here, we added a municipal bond index to our chart, and that's obviously a pretty relevant reference point for some of our clients in high tax brackets where we hold a significant municipal bond allocation. And as the chart indicates with the line in light blue, a slightly positive quarter for municipal bonds, but not as strong as results from taxable bond index that we reference here, which has a significantly higher duration profile. Okay, so here's a quick look at a summary table of third quarter performance results for those who'd rather view it in table format than our line graph on the previous page. Okay, so moving forward, we want to spend some time on the economy, and we're seeing a continuation of decelerating economic growth, especially compared to a strong 2018. Second quarter GDP growth came in at 2%. Not too far away from the average levels that we've experienced over the last 5 years or so. And we don't have a formal reading for the third quarter yet in terms of GDP growth, but expectations are for further moderation and growth to slip below that 2% mark. And as we indicate here in light blue, the Atlanta Federal Reserve, which provides kind of real-time estimates on GDP growth, is currently estimating about a 1.7% growth rate for the third quarter. So we'll see how things shake out here, but we think that that estimate looks fairly reasonable. And we're seeing growth being impacted by weaker international economies and by the global trade disputes, which are having really an outsized impact on manufacturing activity. And we're also seeing a negative impact on business sentiment with corporations a bit more hesitant to commit to large scale investment projects or capital spending due to numerous uncertainties. So drilling down a little bit, here are two 10-year charts focusing on both the manufacturing side of our economy, shown on the left, and the services side, shown on the right. And the dotted black line at the 50 level really marks kind of the dividing line between expansion and contraction. And we can see that the much smaller but still important manufacturing sector has fallen into contraction territory, which marks about the sixth time that this has happened over the past 10 years, but still pretty concerning development. And we don't think it's too controversial to say that tariffs and trade tensions are really the main causes of this weakness. And then focusing on the chart on the right, the services sector, much larger part of our domestic economy, is still in expansion territory, but we're seeing a downward slope there over the past year. So certainly some negatives and concerning economic readings, but there are positives out there as well, which we also want to touch on. So we've seen how the housing market or housing activity perk up a bit. Here we're showing on the chart in the top left new home sales, which have picked up pretty significantly over the course of 2019, and much lower mortgage rates are acting as a tailwind there. And then job growth, the chart we're showing here on the top right, has also slowed, but it's still firmly positive, and we're seeing more than enough job additions to offset new entrants to the workforce. And finally, the chart at the bottom shows retail sales over the past 5 years, still healthy, in line with averages. Consumers are still out there spending, so certainly don't want to skip over the positive economic data points as well. So turning to portfolio positioning and starting with the equity side of allocations or portfolios, we maintained a midpoint equity weighting throughout the third quarter, which we really view as in line with a neutral view on stocks. No real changes to our equity tilts either. We're still firmly weighted to large cap, value-oriented stocks. We, as I mentioned earlier, no dedicated foreign equity exposure after the changes that we implemented in 2018. A few specific individual stock changes or shifts in the portfolios in the third quarter in portfolios where we use an individual equity strategy, but incremental changes there as well. Within fixed income allocations, a slight increase to our PIMCO income fund strategy, where we've really maintained exposure for a considerable period of time. And the PIMCO income fund uses a multi-sector or opportunistic approach, or said more simply, can really go anywhere within the fixed income universe to find value. And we like that approach given how low interest rates are, and frankly, how difficult it is to find attractive opportunities in what we would call or define as core bonds. Okay, I want to spend a little bit of time on performance attribution as well. Stock and bond markets were fairly muted, as I mentioned earlier, but we're pleased with our relative performance results for the quarter, which compare favorably with portfolio risk levels. Our portfolio positioning was really well suited for the trends or outcomes that played out in the third quarter. Domestic stocks continued the run of outperformance versus international. Large cap stocks outperformed small cap or smaller company stocks, an area where we have very limited exposure. And value-oriented stocks, finally posted a quarter of stronger returns than growth stocks, which was also, very beneficial to performance results. And we've listed, fixed income results in the detractor section. Wouldn't really classify this as a firm detractor. Our fixed income strategies performed well with positive returns and generally outpace broad bond benchmarks with comparable duration or comparable interest rate risk profiles. But we did see, another quarter where long maturity bonds outperformed short maturity bonds. So not as favorable of an outcome given our short duration stance. But we remain of the view that investors are just not being compensated adequately for the inflation risk and or the interest rate risk associated with long maturity bond strategies, which we'll talk about in more detail in the next few slides. Okay, so I want to spend some time on the fixed income markets and some of the developments and drivers of recent returns. And here we show a one-year chart that I think really sums things up pretty well in one consolidated picture. And first, we have the 10-year Treasury bond yield, which is the blue line on our slide, which I just used to show the massive decline in interest rates during this period. The 10-year Treasury yield has declined from a little over 3% back in September of last year to 1.69% at the end of the third quarter. And putting that in percentage terms, that's a 45% drop in yields over the past 12 months or so. And if we remember, our bond math, as interest rates fall, bond prices rise, and generally longer maturity bonds tend to perform better than shorter maturity bonds in these conditions. And that's exactly what we see here in the chart with an intermediate maturity bond index or ETF, exchange traded fund, in yellow, up over 10% during this time period, while shorter maturity focused strategies shown here in orange and gray, still performing well, but not to the same degree as the longer dated strategies. So long maturity bonds have performed very well over the last 12 months with results, handedly exceeding our expectations. And with our relatively short maturity positioning, we haven't participated in this bond market rally to the same extent, but we think investors, and especially investors holding long maturity bonds, should start to question if these return results are sustainable going forward, and what things would look like if interest rates increased or moved back up to more normal levels. Okay, so here's kind of the other side of the coin compared to the slide we just reviewed. In the final 6 months of 2016, the 10-year Treasury bond yield, again shown here in blue, increased 65%, moving from 1.49% up to 2.45%. And the exact opposite outcome unfolded with longer maturity bonds, again here in yellow, dramatically underperforming the shorter maturity focused strategies in orange and gray. So, our takeaway or our point here is just that with interest rates already so low, we don't want to be making a big bet that they're going to continue to decline, from here, especially when that outcome or when the outcome of that bet could be, extremely negative if interest rates stabilize, i.e., move higher. Okay, and then, our final slide here provides a look at the relationship between bond yields and stock yields over the past 25 years. And for bonds, we're using, again, 10-year Treasury bond yields, and for stocks, we're using the dividend yield for the S&P 500 index. So obviously there are corporate bonds and high yield bonds and different types of bonds out there which may provide higher yields than 10-year treasuries. And there are certainly stocks that offer higher yields than the S&P 500, but we're just using these two proxies as a good, down the middle comparison between stocks and bonds. And we can see that in the past, there used to be a significant amount of yield advantage with bonds compared to stocks. If we look back to the mid 1990s, bonds yielded about 4 percentage points more than stocks, or about 2 percentage points more than stocks in the mid 2000s. But we're in a period now where stocks actually provide higher yields than bonds. And I think the point that we want to make is just that it's a fairly rare occurrence if we look at the last 25 years, and one that we think is supportive of equity markets. Okay, so with that, we'll go ahead and wrap things up. As always, if there are any questions or any points that anyone would like to discuss in greater detail, please feel free to give us a call or send us an email. Thanks again for your time, and we'll be back to you in early January with our fourth quarter update.